Hi, welcome to Looking at the Markets with David Modell. We're back with Seth Golden, blogger, article writer, Twitterer, and stock twitzer extraordinaire. So much is going on in this earnings season that I just had to catch up with Seth and get more wisdom from him, and everybody can benefit from that. Mr. Golden, good to see you again, sir, today.
Thank you. Thank you for having me again, David, and hopefully we can deliver some information to your readers and investors.
Yeah, absolutely. A lot of hits on the first video we did, and I'll put a link to that. And I will, of course, put a link in the description to not only your contact information, but your latest article, or one of your latest articles, which you sent to me so kindly. And the title of your latest Talk Markets blog or article is Fitbit Finds Itself Restructuring Through 2017. I'm terrible at this, so I'll let you, if you'd like to sum up your opinion on Fitbit.
Sure. Only a few days ago, Fitbit came out with preliminary Q4 and full year 16 results, and they even obliged with their thoughts or guidance on fiscal year 2017. Essentially, it was a pretty bad quarter for Fitbit during the holiday period, and it basically resulted in them remodeling for the full year from, I think it was 25 to 28% revenue growth,
right,
down to 17% revenue growth for the full year. And then they also outlined that they were going to restructure, in a sense, streamline operations, cut staff, cut R&D expenses, cut advertising and promotional expenses, otherwise known as marketing efforts, and really just overhaul the business to basically come in line with what the true demand for their product is. Essentially, they have way too much overhead. Capacity utilization is not in line with demand. There's a huge gap there, which is going to result in net operating losses next year. So going forward, essentially, I believe what's going to happen to the company through 2017 is they're going to experience a lot of bottoming of sales, bottoming of earnings, bottoming in gross margins, to essentially emerge into 2018 with a more realistic picture of what the story is going to be going forward for Fitbit, for consumers engaging with the brand and with their products. So much of 2017 is going to be malaise. The stock isn't really going to do all that much. You may go through some fits and starts whereby the stock appreciates, then depreciates,
right,
but it's really not going to see any significant movement upward through 2017. There's just far too many headwinds and far too much overhang in the stock right now.
Gotcha. Reading your Talk Markets blog article, you mention that, or you seem to imply that leadership might be to blame for the lowered guidance here when it comes to Fitbit, and you compare them to Best Buy and Walmart. You mentioned those examples as possible failures in leadership. Would you attribute what's happening in Fitbit to that as well?
Well, more specifically, what I outlined was the failure in leadership at Fitbit. Came from. It happens with all of these gadget, quote unquote gadget vendors. SodaStream, Keurig, Skull Candy, GoPro. Essentially, they see this really outsized growth period whereby it's all distribution growth. They're growing distribution around the world with all these different retailers. So they don't have a true picture of what the demand is from the retailer to the end user, the consumer. They're shipping in tons of case packs. But the retailer is only selling one out of that case pack, maybe every week, maybe every month, depending on the retailer. So you have this big gap in communication between the account executive. So let's say there's an account executive from Fitbit handling the Walmart account, okay?
Right.
And she doesn't know what the real sell-through of the product is from Walmart to the consumer. So she's not delivering that information, that data, to the C-suite, to the executives, so that they can produce the right amount of product to meet the actual demand. So instead of shipping or producing case packs or volumes of these fitness trackers, they should only be producing onesies and twosies, because that's all that's really going out the door. So there's that huge communication gap there that exists with all these hardware-centric business models.
Okay.
And you're going to see a lot of shakeup in the staff. You're not going to have 6 account executives handling Walmart or handling Target. You may have 1 or 2, because that's all that really needs to be had at this point. There's not going to be the abundance of orders this year that Fitbit saw last year.
Okay. Recent partnerships with Medtronic and UNH, some people might see that as massively bullish. What's your take on that?
These partnerships are they're slow moving. It will take years to actually develop any meaningful revenues from these partnerships. For the sake of, let's say, the partnership with Medtronic, it's more a platform partnership than it is a hardware revenue driving partnership, whereby Fitbit would be selling their fitness trackers to Medtronic. That's not how this partnership's going to work.
Okay.
Medtronic has their own devices. They're essentially just going to use the Fitbit platform, the software platform, or the operating system, with their existing customers. So Fitbit may only get a licensing fee. Instead of talking about millions and millions of dollars, tens and hundreds of millions of dollars through actual hardware fitness tracker sales, they're likely just to get a few $1 million in royalty fees over years. When it comes to UNH, that has that's more of a revenue driver. However, again, it's going to be slow to scale. UNH is not jumping in with both feet and buying hundreds of millions of these devices for every single one of their healthcare premium customers. They're going to buy a few thousand, maybe a few 100,000, and see what the actual efficacy is with their consumers using this device before they ever do anything on a grand scale.
Got it. Okay. And how about a possible acquisition of Fitbit? That could be bullish. Some people might say. What is your take on that in the near to midterm?
I'd say anything's possible, but investors should invest for the sake of probability, not possibility.
Right.
The probability is extremely low. It's almost unheard of for this type of business model that has already gone public to be acquired in less than 2 years of its public existence. Additionally, any acquirer would want to know what the true demand is of this product. They would want to know what is the true cash flow after all the distribution gains are gone and you're left with retail to consumer demand. Without a real understanding of that, you can't get a true valuation of what you should spend to acquire this company, and it's why it almost never happens.
Right.
It takes years, for this type of business model, to really express its true value and true, cash flow. That being said, again, anything's possible.
Right, of course. And you like to play the probabilities, which is what I always tell people. People who play the lottery, they're thinking about what's possible, not what's probable. And so I totally agree with you in this one. So if somebody already owned Fitbit stock, are you actually recommending that they sell it, sell part of it? What do you think?
No, I think, I look at book value. I look at the peers in the space, your GoPros, your Soda Streams, even your former Skull Candy before it was acquired after years of malaise and downturns in its business. And Fitbit, their book value is $5 a share. GoPro's book value is $3, 3 plus a share, and it's trading at roughly $10.
Yeah.
So there's a misvaluation going on here. SodaStream's trading at $44. Its book value is 13 and change. So, I think you're pretty safe here. If you want to accumulate or hold on to your shares, you're probably in a good position long term. And that's really how you have to think about this. The book value is $5 a share. It's trading roughly at that price now.
Yeah.
Your downside's very limited. So your risk reward is actually pretty strong to the upside.
Yeah. I see it at $6 and change, a little bit of change right now, so not far from the book value. Do you, just philosophically, do you generally use book value to determine, as opposed to charting and all that? I know you're not a huge chart guy. Is book value a good starting point for finding the true value of a company?
I would say it's not the only, you can go through various different ways to understand the true value of the hardware centric business model. But a base case scenario, yeah, I would go to the book value and see where it's trading as a multiple of the book value today. And then I would go to sales. Right. Because these business models tend to also be valued on sales. And even when you look at sales, you look at Fitbit sales, even in the worst case scenario, which is forecasted to be $1.5 billion next year, and you compare it to GoPro, same business model, they both sell hardware, they have no recurring revenues, and GoPro's trading substantially higher with less revenues. Yeah. So again, whichever way you look at it, there's an extreme undervaluation going on here with Fitbit. Understandably, it's been heavily shorted, and management hasn't executed. So
sounds to me like, at least in my opinion, GoPro underweight, Fitbit hold.
Yeah, sad to say, I would not be a buyer of GoPro, in the $10 range. It just seems like the valuation is too high. And again, they have no profits as well, and no real path to profitability based on their product alone. Yeah. Business model centered on that product.
Very good, sir. Before we go too long, I want to give you an opportunity to let people know how to contact you for more wisdom or on the markets. If they want to read your blogs, your articles, and your Twitter and StockTwit feeds, how would they do that?
Talkmarkets.com. You would simply just type in my name at talkmarkets.com, and a list of my articles and analysis would come up there. Twitter, Seth at SethCL.
Gotcha. Okay. And email address as well. If you want to mention that, you certainly can. I'm going to put all this in the description as well.
Sure. Seth.golden at coollinxit.com. COOLINXIT.com.
Yeah, you're going to want to check that out for sure. And Mr. Golden, I'm speaking with Seth Goldman, frequent tweeter and StockTwits poster, and as well as Talk Markets and Seeking Alpha contributor. Always worth reading. Do you mind, sir, if I do a little lightning round and mention a few tickers that I like?
Sure, please do.
That'd be great. Sorry to put you on the spot like that, but I want to get you. I want to tap into your wisdom while I can. Target. What do you think? It's just kind of going sideways right now. Any outlook on that?
Yeah, when it comes to best of breed, certainly Target is amongst the best of breed. So you're not hurting yourself. When you compare them to some of the other retailers out there, it has a really strong dividend yield at 3.7%. So it pays you to wait. Certainly, if you compare it to the likes of J.C. Penney with no dividend and rather poor results to finish out the year, as most retailers have. So yeah, in terms of best of breed, great operator, I think, and a huge buyback, $5 billion. Target's a good bet. If you were to look at scaling positions, think about the dividend. If it goes down another 3%, that's where you pick up shares, and you've covered your dividend there as well.
Right. Okay. Gotcha. No dividends for me. I bought calls. So
Gotcha.
What are you gonna do? But yeah, great advisement there. And let's see. I wanted to look at Rite Aid. Falling off a cliff. Is this a falling knife or a bargain?
Yeah, I don't follow Rite Aid all that much. Having said that, not really a best in breed. CVS, Walgreens, being in that category, it's had its struggles over the year. It's gone through fits and starts over the last, I would say, 4 to 5 years, where it's been a darling of Wall Street, and now it's back in the cellar again. So it's one that I would avoid until you see some strength there or rebounding in results.
Gotcha. Okay. Want to look at another retail standout, or not such a standout, Macy's. What do you think of that one right now?
So a lot of headlines there today. New York Post had a pretty eye-opening, we'll call it a rumor that the company is for sale, or entertaining the thoughts of the sale, with the CEO stepping down. I've been, analyzing Macy's, for a number of years, and warning investors from the start of 2016, when they outlined their restructuring, that this was going to get worse. There's a reason retailers go through a restructuring. It's because they have a lot of pain points that take a long time to readjust the business to. So here we are at $30. You get a rumor that they may be selling themselves. The rumor doesn't make a lot of sense to me, especially if Starboard is the catalyst for this rumor or this sale activity. It doesn't fit with, you look at the market cap, you look at the debt. So somebody would have to pay a premium to that market cap. We're talking greater than $40 a share. They would have to assume this $7+ billion in debt, and then hope to find a buyer for those real estate assets that Starboard has been, pushing to get monetized for the last year, well, since late 2015, actually. I mean, Starboard's been buying the stock in the 50s, and it's down in the 30s.
Yeah.
There's not a lot of logic there to this rumor. Having said that, there's a lot of dumb money out there, so you never know.
Nice. A couple more, if I may. Costco. I love me some Costco, but that just means I like to shop there. What do you think of it as a stock right now?
Yeah, so I picked up Costco actually at 144 a few months ago during its pullback. And I call it a pullback because if you look at the chart, here's a time where I like looking at the charts. When you look at the chart, I mean, you can go back as far as you want. The stock does nothing long-term but go higher. So when it pulled back to $144, I was a buyer.
Yeah.
I wrote an article about it. You can find it at talkmarkets.com. And essentially, they're emerging from a period where, the currency exchange rate was unfavorable. The drag on gasoline prices was unfavorable. And some of their costs for their, associated with their grocery was unfavorable as well.
Right.
So year over year, they're lapping some rather low comps. And today you get, an extreme benefit from it, where the company grew comps something like 9% and the stock rose pretty significantly. So I continue to hold the name in my portfolio, in the Golden Capital portfolio, and it looks like it should achieve all-time record high trading prices in the near future.
Got it. Yeah, I'm looking at the chart right now, and yeah, it goes up over time. Even market crashes didn't hurt it.
Exactly.
Comparatively speaking, market crashes didn't even hurt it that badly. So that's a buy and hold, definitely. All right, and finally, how are you playing, if you are playing, any VIX products right now?
Yeah, I'm always in the VIX product market, whether it's the VIX itself or VIX leveraged ETFs. I always maintain a core position in UVXY, which is a double leverage product. The VIX is relatively low right now.
Yeah.
It's due for a spike, certainly. It's long overdue for a spike, and if you've got plenty of cash on the sidelines, because the nature of volatility is to remain complacent, far level than it exhibits, outsized fear, if you will. Those are the opportunities when these instruments spike in share price, to start layering in to some of those shorts, or opening up some put options, or things of that nature. So I welcome volatility.
Sure.
The shorts that play volatility,
right,
welcome it. And unfortunately, you can't make a lot of money in these products without volatility coming back to play.
Right. My philosophy on that has always been volatility is always around the corner.
Yeah. Sometimes that corner is a little bit longer than others.
Right. But just when it feels, for anybody out there who did not trade in 2007 or 1999, 2000, those were times when it felt like, when is volatility ever going to come back?
Right.
Yeah.
Right.
But
the one thing to keep in mind when it comes to volatility, I mean, it doesn't matter how far you go back. The longest volatility lasts, so far as extreme fear is concerned, is a matter of weeks. That's it. Even back to 2008 or 2009, the financial crisis, it was a matter of weeks that it took for the fear index to pretty much hit its peak and go down from there. Even taking into account some fits and starts, it elevates to a point where the market can't function properly, and past that point the market will correct itself accordingly.
So it's just a matter of having that iron stomach to just
those few weeks.
If you've shorted any VIX products such as UVXY, as long as you and I always tell people, take a small position size.
Correct.
Yeah, that way a small percentage of your account. That way you may have to sit through a massive spike after you short it, but if you're willing to wait it out for a little while, and plus these products are designed to go down in value. UVXY, VXX, TVIX, they decay like crazy anyway. So.
Correct. Yeah, they're specifically designed. It's not left to chance.
Right.
It will go down. These will go down over time. It's just a matter of your ability to maintain liquidity.
Yeah, absolutely, and hence the small position size relative to the trading account. Awesome. That's actionable advice right there. In addition to everything we heard today about Fitbit and Costco and all the others, I think I'm going to add some Costco to my own portfolio. And if everybody out there would like to learn more about what Mr. Seth Golden has in his portfolio, or what he may or may not recommend, once again, how can they contact you?
You can email me directly, seth.golden@coollinksit.com. You can comment on any of my many publications on Seeking Alpha or talkmarkets.com, or engage me freely at SethCL on Twitter, or Seth Marcus at StockTwits.
Yeah. Please, leave comments on Mr. Golden's articles. Give him a thumbs up or 5 stars or whatever they got on there. I always do. And check him out on Twitter and StockTwits.com. He's a frequent poster. Valuable stuff. Why not take advantage of it? Mr. Golden, as always, thank you so much for coming, and you're welcome back anytime, sir.
Thank you, and thank you to your audience, and best of profits to everybody in 2017. Good luck.
Thank you, sir. All right.